Welcome back to Your Average Investor, the channel that looks at my journey through investment, budgeting and finance. In today's video, normal service is resumed and we take another look back at my trading 212 account and I make another small investment as part of my pound cost averaging strategy. There's been quite a lot of volatility in the market recently, so it's interesting to keep on top of how this is affecting my portfolio over time. If you do find videos like this interesting, please do consider subscribing to the channel to catch all of my portfolio updates in the future. And without further ado, let's hop onto the Trading 212 platform and check out my investment portfolio. Here we are back inside my Trading 212 Invest account. You'll be able to see that the overall value of my current portfolio is £568.63 from a total amount invested of £496.04. My investments are currently returning to me £72.60, which equates to a rate of return of 14.5% or around that. For those of you who caught my last Trading 212 update, you'll notice that the overall value of my portfolio has increased from £531 to the £568 you see on screen now. Equally, my total amount invested has increased from £432 to £496. This shows that I've continually invested over that time, and I've also accrued 2 extra free shares. Now, when these free shares are added, even though I don't have to pay for them, they do show up in the total amount I've invested, which does skew that somewhat. To compare my total rate of return from previous to now, in the previous video, my total rate of return was £98, which equated to around 22%, whereas now you can see my rate of return is down to £72 or around 14.5%. This shows that even though my total amount invested has increased by over £60, my rate of return has actually decreased by around £26, showing that over the period I've actually taken a slight loss. This current volatility is driven by fear, which is partly due to worries of a second peak of the coronavirus, and also because of the potential economic crisis to follow as we come out the other side of coronavirus. While people will argue this is already priced into the stock market, there are still lots of people fearful out there, which is driving this volatility. We can take a look at this in a bit more detail by looking at individual indices and how they've performed over the last month. This is an example of Vanguard's Footsie 100 tracker, and you'll be able to see the steep incline and then steep decline throughout the month. This pattern is then echoed in Vanguard's S&P 500 tracker, with a similar increase and decrease around the same sort of dates. While there are lots of supporters of geographical diversification, because it does help to hedge against some volatility in individual markets, you'll be able to see that most of the markets I've shown on screen do still follow the same trends. The really pleasing thing about all of these ETFs is that they track indices very closely. So from that, we can see that over the last month, the Footsie 100, the S&P 500, the Vanguard Asia ex-Japan, and the Vanguard Emerging Market Funds have all increased over the previous month, which does suggest that a trend in the positive direction. That begs the question then, if we've seen a trend in the positive direction on most of the global markets, why has the value of my investment decreased by £26 over the last week or so? This is where the main difference between investing in indexes or investing in individual companies arises. As you can see, if I'd invested in those individual indexes over time, I'd have seen a positive rate of return in the last week or so. However, because I've invested in individual companies, some of the companies that I'm invested in might not have performed as well as the overall index within that same time period. And therefore, the value of my investment has actually decreased, whereas the overall value of the market has increased. This really epitomises why diversification when investing in individual stocks and shares is very, very important, as it will help you to ride out and even out that volatility which you could see from some of the stocks you're invested in. We've just reached the 1 month anniversary of my investments within Trading 212, so an overall rate of return of 14.5% is very, very pleasing in that time, so I can't complain at all. If we take a look at my individual investments, you'll be able to see that over the time of holding this portfolio, Amazon, Apple, Boeing and BP have all netted me a positive rate of return. Both Amazon and Apple have increased in value since filming my last video, whereas both Boeing and BP have both decreased in value. It's important to remember here that I'm a long-term investor, so while it's interesting to look at the individual daily increases and decreases and the market volatility, I'm not too worried about it, as I'm holding these for the long term. So as long as they're in a positive rate of return in 20, 30 or 40 years, I'm happy. I've got around £26 invested in Coca-Cola, which is currently seeing a rate of return of negative 2%, which equates to around a 55p loss. EasyJet's seen a fairly volatile week, and in last video I was actually up around 33% from EasyJet. In that time that's dropped now to around 24%, which is £8.50 in return. However, again, as airports open up, I can still see this increasing, so I'm not going to sell out of here. News came out this week that there might be safe havens between England, Greece, Portugal and France, meaning that people can still take some holidays without having to quarantine on arrival. If this does go ahead and flights do go out from the UK, then I can see EasyJet increasing in value again as this happens. Again, a rate of return of 24% in the month I've held EasyJet is very pleasing, so I'm not unhappy at all. My investment in Facebook is up around 6%, and Lloyds Bank, whilst it's not had the best week in the stock market, with lots of worry around banks at the moment, it's still seeing me a rate of return of around 10%, which equates to £1. This is one of my smaller investments, which I will keep buying into over time. However, I fear that at the moment it might not be the best time to continue buying into banks with what could potentially happen over the next 6 months. That brings me back to Nicola Corporations, which, as you remember from last video, was up around 120%. As I said in my previous video, I didn't expect it to stay up at around 120%, and as you can see, it's dropped back to 67% in the last week or so. The rate of return from this company has fallen from £42.50 back down to £31.94. But again, in the few weeks I've held this company, I cannot complain at all. And I do still see this company growing in the future. Even though it might not come in the next month or so, it could not even be in the next year. For the long term, I can see Nicola Corporation becoming a strong company. Now, there is still lots of speculation around this company, as realistically, they've still not actually made any money. So there's arguments about whether their share price is still valued too high. While no one can predict the future, the more reading and research I do around the company, the more I can see them as a diverse and emerging and innovative company which will be around for the long term. While now might not be the best time to buy in, as I can see their value decreasing over the next few weeks or months, I was fortunate enough to buy in before they merged with VTIQ at around $30 per share. The upsides in this case are greater than the potential downsides with the size of my investment. My investment in Royal Dutch Shell has dropped back from a rate of return of just under 10% to around 3%, which equates to around a £4 difference since the previous video. And my investment in SSP Group has dropped back again by around 15% from 31% in the previous video, meaning around a £2 loss. The other three companies in my portfolio are Starbucks, Tesla and Walt Disney. Starbucks is now netting me a negative rate of return, which again is not from a massive investment, and I'm not too worried as Starbucks hasn't properly opened back up yet. I know I can say this in every video that I do, but I really do think as the economy starts to open up and people start to get back to whatever new normal will be, cafes, bars, shops will open up and people will go back to them. This will of course increase the share price, as the companies will be making money again, and therefore I will hold on to this Starbucks investment, albeit a small investment. Tesla has had an excellent few weeks, with it finally hitting over $1,000 per share. This company really has seen an excellent year, with an increase in value of 350% to date. This now makes it the highest valued car or vehicle company in the world. The real question is, will it maintain this value or will it drop off in the next few months? Either way, I don't care too much. I'm going to continue to invest in this company as I really like Tesla. If they do drop in value, that poses a really good buying opportunity for me. If this does happen, I do have cash on hand to invest back into them, as I can always see them bouncing back. They're still a fairly new company when you think about it, and they are still very volatile. My final investment is in Walt Disney, which at the moment is seeing a loss of 55p. If you have a look at my allocation, you'll be able to see my overall portfolio. From this, you'll be able to see that Boeing is the largest company in my portfolio, with around 15.8%. Nicola Corporation and Tesla then make up 2 and 3. Now, this does mean that my portfolio is heavily weighted to the automotive and air industry at the moment, which is something that I will be looking to change in the coming weeks. The main reason for this is because of the Nicola merger, which I decided to get into before the merger and therefore invested a fair amount into Nicola, and also because Boeing posed an excellent buying opportunity when I initially got into them, and therefore this is the reason why they're the top 2 holdings in my portfolio at the moment. If you scroll down a little further, you'll be able to see that Apple, Royal Dutch Shell and EasyJet make up around 27% of my portfolio in all. BP, Amazon, Coca-Cola and Walt Disney make up a smaller percentage, and then the small amount of other shares makes up around 8.7% of my portfolio. One thing you will notice from looking through all the companies that I'm currently invested in is that I don't currently have any allocation towards the pharmaceutical business, which is something that I'm going to change. At the moment especially, pharmaceutical companies are at the forefront of trying to find a vaccination and a cure for COVID-19. There's lots of competition out there to find this cure first, and the company that do find this cure first are likely to see large increases in the value of their shares. Because of this, and following the research I've done into the companies, I'm going to invest in two of the pharmaceutical giants today, with Johnson & Johnson and Astrazeneca. Now, if we take a look at Johnson & Johnson, you'll be able to see that they're currently valued at around $144 per share. You'll also be able to see that this company's steadily increased in value over time, which is a good sign. And the dividend yield is around 2.81% per year. Whilst there is the potential that this could get stopped in the short term, this does pose an excellent dividend opportunity for the long term. This will be able to give my portfolio steady income over time. Now, I'm not going to spend too much time looking into the financial summaries because I've done this previously and I don't want to spend too much time on that in this video. However, you'll be able to see that they've got a net income per year of around £15 billion. And while they do almost have $100 billion in liabilities, they do have around $160 billion in total assets. Couple that with the fact that these are one of the forerunners in the COVID-19 vaccination race, I can see this company both giving me good dividends returns and also the potential of some actual capital growth as well. This is a strong company within the US market which has performed extremely well over time, so this is a good company for my long-term future. The second company is obviously Astrazeneca, and again you can see over the length of this graph, Astrazeneca have increased in value by over 215%. Now, Astrazeneca are one of the big pharmaceutical companies within the United Kingdom space, and therefore this provides me global diversification across my pharmaceutical investments. Couple that with a dividend yield of 2.57%, and you can really see the strength of this company. Therefore, this is an investment which I can see becoming a large portion of my portfolio. I've just added £50 to my investment portfolio then, and I'm going to make an investment of £25 into both Astrazeneca and Johnson & Johnson. Now, while the UK stock market is currently open, the US stock market isn't, which is what Johnson & Johnson is traded on. Now, I wouldn't normally make an investment into a company when the stock market is closed. However, for the purpose of this video, I will still invest in Johnson & Johnson now. For those of you who haven't bought shares on Trading 212 before, you'll be able to see quite how simple it is. To start off with, we'll look for the company we want, which is Astrazeneca, which we've already got here. We'll simply click Buy, and then you can select either the number of shares you want, or the value which you want to invest, which in this case, the value is the one we're going to go for because we want to invest £25. So we'll tap value and then we'll input the amount of money we want to invest. Once we've input the amount of money we want to invest, we can simply tap review order and then we'll send the buy order. Here, because we're investing in a United Kingdom share, we'll pay a small stamp duty, in this case 12p. And there you'll see that the order has processed almost instantly and we're now investors within the Astrazeneca company. The second company we want to invest in is Johnson & Johnson. So again, we'll simply find Johnson & Johnson, which you'll see is on one of my recently viewed shares. And then again, we'll do exactly the same process, type in £25 worth of value. It will show you how many shares you'll get. We'll review the order there. Because we're investing here within America, we don't have to pay stamp duty. And of course, Trading 212 is commission free. So we'll send that buy order. And whilst that won't settle now because the stock market over there isn't open yet, you'll see it listed under a pending buy order, and that should fill fairly quickly once the market opens. As I've already said, the reason for choosing those two companies is because I see them as strong over the long term, and they both provide a good level of dividends. The American Stock Exchange has now opened, so my investment within Johnson & Johnson has processed, and that leaves my portfolio valued at £618.66, meaning I've invested a total of £545.92. Currently, my rate of return sits at around 13.5%, with my investments returning to me £72.88. We'll have another quick flick through my investments. You can see that my investment in AstraZeneca is ever so slightly down since I've purchased. Coca-Cola is still slightly down. Johnson & Johnson as well is about breaking even with it being 2p down. But everything else is fairly in the green, apart from Starbucks and Walt Disney. As you can see, Boeing, Nicola and Tesla are still my top 3 allocations. However, I've added 2 further investments to my portfolio. What you'll see over the coming few weeks with my portfolio updates is that I'll continue to pound cost average into these companies that I'm currently invested in, and that allocation will change somewhat, so those 3 probably won't be the top in a few weeks' time. But there we have it, that's my portfolio as it looks now. If you haven't started using Trading 212 yet, why don't you sign up and deposit just £1 into your new account? By doing this and by using my referral link, you'll get 1 free share valued up to £100 with just a £1 deposit. So there we have it. Once again, I really hope you've enjoyed this video. I know personally I really enjoy watching some of the smaller YouTubers talk about their investment portfolios, what they're investing in, and then how that portfolio has grown over time. If you enjoy videos like this as well, please consider commenting on the video to tell me your investment strategy and how your investments are going at the moment, and also consider liking the video. In my next video, we're going to take a little look at something else that Trading 212 offer, and we're going to take a jump into the murky world of CFDs. Hopefully I'll catch you there for that one, and with that said, I'll see you next time.